So now we're going to talk to Stephanie. Good
Hi,
morning.
James. Good morning. Good morning from New York. Thank you.
Very early morning for you.
Yes, yes.
So, thank you very much for doing this.
No problem at all. This is I've been up for ages.
Okay, thank you. Right, so I think we'll start off the usual way. So I know you've done this before, but for those people that didn't see that show or for maybe want a refresh, can you just sort of run through what RTW Ventures trying to achieve, please?
Yeah, for sure. So, let me begin there and give all your listeners today a glimpse into the RTW Venture Fund. We'll talk about who we are, our investment approach, and track record. We are a London Stock Exchange premium listed company managed by RTW Investments. Now, RTW Investments is a global investment manager with about $5.8 billion in assets under management, a team of nearly 80 people, and offices in New York, London, and Shanghai. Our aim is to invest across the full life cycle and build a portfolio of companies that are powering breakthrough pharmaceutical, biotechnology, and medical technologies that will transform the lives of patients impacted by disease and disability. So we're really looking for companies developing therapies or technologies that we believe have a clear pathway to making it to patients, not just great sort of theoretical ideas. Now, with this fund, shareholders get access to what we think is a truly differentiated investment product that's typically only accessed by some of the most sophisticated investors and institutions globally. We've brought that same portfolio to shareholders who can trade shares in this on the London Stock Exchange with lower fees than the hedge funds and with daily liquidity. Now, the parent company, RTW Investments, manages other funds, with the flagship hedge fund boasting a 14-year track record and has annualized about 24% net of 2 and 20 fees. For us, it really all starts with the science. And over the years, we've sharpened our process that's informed by an unparalleled collection of primary scientific data, where we put it into a library and synthesize that so our research team and our investment team can access and understand and track every key breakthrough that happens in the scientific world. We invest in public companies, which is where the RTW investment business started. But then over the years, we've shifted earlier and we invest in early and late stage private companies. And we even go as early as incubating our own companies with the end goal of building scalable businesses that can be built around compelling assets that we uncover in academia. So that's how early and how small we might go. That's actually the beauty about the structure of this this listed investment company, RTW Ventures, because it allows us the flexibility to build a diversified portfolio across geographies, capital structure positioning, clinical development stage, and company lifecycle position. And this fund, again, benefits from this very same philosophy and process that has generated considerable returns for the flagship fund since 2009. Now, if you start to unpack those returns, we do get paid an illiquidity premium, and our private investments have historically generated even better returns than the public investments. RTW Venture Fund shareholders receive a twice as large allocation of private exposure versus investors in our hedge funds, for example. Since launch in 2019, the venture fund's NAV has returned 48%. Net of fees, and share price growth has grown by 25% in spite of the historic sector drawdown in the last 2 years. Okay, thanks for advancing the slides. RTW is known for being a science-driven firm, and we've had to grow our team in order to keep pace with all of the innovation in this expanding industry. There are 29 members of our team with medical and scientific degrees who apply this deep domain expertise to evaluate opportunities through one of 3 lenses that you see on this slide. So either they have an expertise in a specific modality or technology, such as gene or cell therapies, antibodies, RNA medicines, or they have a focus in a particular disease area like oncology, cardiovascular, or CNS, or their expertise lies in a functional discipline like commercial forecasting, manufacturing, or intellectual property. And these strengths actually enable the team and fosters a very collaborative environment so that people contribute, their own expertise and work together as one team. Next slide. So we're proud to say that RTW has a presence on 3 continents. Our headquarters are in New York, and in the last 2 years, despite COVID and despite the historic sector correction, we've expanded our reach, and we've opened offices in London and Shanghai. So you might ask, why not stay local? The US is considered the world leader in scientific innovation and has a rich capital markets ecosystem to boot. Well, the answer to that is multifold. First of all, we recognize that great science is happening in many places outside the US, and we've positioned ourselves to capture investment opportunities around the world. Furthermore, we think it's important to foster and help develop emerging biotech and medtech ecosystems. And we can do that in myriad ways. By providing capital is the obvious first way, but by being also a good and friendly syndicate partner to local investors, such as here in the UK, and also by bridging the West and East by bringing new innovative products into countries like China. So through our Chinese operating company, which we'll talk about in a bit, Jixing, we can bring innovative medicines in the fields of cardiovascular and ophthalmology to patients in China who don't have access to the latest in Western scientific advances. So it's a win for the Western companies too, who now have the opportunity to tap into a large commercial opportunity. Our work here in the UK and by extension in Europe is more about supporting companies with our capital and working with universities and developing partnerships with academic institutions so that we can help them advance their best discoveries and get them from the lab into the clinic. So I've used the term full life cycle investor to describe what we do. And you might be wondering, what exactly does that mean and why does that benefit RTW Venture shareholders? Well, we've found that being a full life cycle investor provides us with a competitive advantage over investors who focus just on privates or those who focus just on publics. Access to early stage investments, assets provides us with significant information advantage. Mid to late stage venture enables that period of time where you can really build relationships with entrepreneurs, management teams, and sometimes, through formal ways, and build influence, for example, on a board. Now, as long-term investors, we view the IPO as just another step toward full value recognition rather than seeing it as a chance to exit, as many conventional venture capital funds do. And that's important because a lot of the value creation actually occurs deep into the public part of a company's life cycle. So we don't invest to build and sell at the nearest opportunity. We have the structure and the patience to capture as much of the long-term value as possible. Over the last half a dozen years, we've pushed ourselves beyond minority or passive equity investing to become business builders and partners. Our science-led research team is complemented by a team of seasoned ex-investment bankers, lawyers, venture capitalists, and company operators. Their strategic planning, creative execution, and financial engineering has enabled us to build and help build some impressive businesses. That in turn enables us to maximize a company's odds of success and ultimately deliver outsized returns to our investors. So across the columns on this slide, these are among the types of investments we can make outside of plain vanilla equity: licensing, capital markets, SPACs, and royalties. And these are all what we look at as enabling products for companies. Okay, so now let's turn to the RTW Venture Fund portfolio and performance. So we offer shareholders a portfolio of meticulously sourced, innovative biotech and medtech companies. And depending on how you slice and dice the data, there's diversification across subsector, disease area, and stage of development. 84% of the portfolio is in therapeutics, with 16 in medtech. In the middle, you'll see that oncology and inflammatory diseases actually represent the two largest segments, with cardiovascular and neurology right behind. And then almost 20% of the book today is in large cap names. That's greater than a $5 billion market cap, 44% in mid cap names, and the balance is in small caps with sub $1 billion market cap companies. Next slide. So these three companies, Rocket, Jisheng, and Yarrow, are the results of three of our own incubation efforts. Rocket is a company we founded in 2015, and today is among one of the top largest publicly traded gene therapy companies in the world. Last year in 2022, Rocket shared positive data on both their lead program, Fanconi anemia, and LAD, and both have recently crossed the bar set by their registration endpoints. They also announced a positive update on their cardiovascular program targeting Danon disease, which is a rare genetic heart disorder. And also in 2022, Rocket announced the acquisition of a cardiac gene therapy company, Renovacor, showing their ambitions for growth to the market, making a strong statement in an otherwise challenging market. For Jisheng, right there in the middle, pipeline building and operational execution have both been great, and it brought Jisheng probably about a year away from commercializing its first product and hopefully aiming for a public listing in Hong Kong in the not too distant future. Now, especially now that we're beginning to see evidence of a recovery in the Hong Kong stock market. The third company here is called Yarrow. Yarrow is small and has not yet raised institutional capital. It's fully funded by RTW Venture Fund and the other funds managed by RTW. And given the market environment, we've seen competition for licensing deals decline. So, but which is good for us. But to emphasize, there has been no shortage of interesting assets to consider for Yarrow's pipeline. So while the public valuations today are very compelling, and then maybe the late stage private valuations are not as attractive because they haven't been reduced, we're also seeing a very compelling opportunity emerge in that early stage asset acquisition. So we're looking at a lot of really interesting licensing deals for Yarrow, and we're not disclosing the assets in Yarrow's pipeline quite yet, but we're focusing on applying ASO technology, most likely to CNS disorders. So stay tuned for more on that. So I thought it might be interesting to actually walk you through one of our portfolio companies, and this is a case study on Prometheus Biosciences. Prometheus is a company that has been focused on IBD, inflammatory bowel disease, since it spun out of Cedars-Sinai in 2016. The company's anti-TL1A MAB, monoclonal antibody, is a new mechanism of action in IBD with best in disease efficacy versus all of the existing mechanisms of action. This has also been validated by a competitor, which is a drug being developed by a partnership through Pfizer and Roivant. But Prometheus's data is better, and we believe that it has a good chance of becoming a first-line drug. So each existing IBD drug class is multi-billion. This is a really big market opportunity. Prometheus also has a precision medicine companion diagnostic, which is a paradigm that has actually revolutionized personal medicine in oncology. So it's a new paradigm in immunology and inflammation. But there is a proxy for success, and let's hope that this also opens the door, to great things for immunology and inflammation, or I&I indications. This diagnostic approach is a platform that Prometheus is also using for other drugs in their pipeline. Now, what next for the company? Big pharmas with IBD franchises like AbbVie or Johnson & Johnson or Takeda may look to bolster their pipelines with an asset like this. Now, we don't own it because it could theoretically be an acquisition target. We don't ever really tend to invest with possible takeout in our minds. But with increasing talk of the need for large pharma and big biotech to replenish their revenue drivers as their big drugs roll off patent, they're going to have to start identifying companies that can replace those revenues and deliver a new and better standard of care to patients while positively impacting their bottom line. So this, could potentially be a targeted company. Now, in December of 22, you might notice that big jump in share price. About a month ago, Prometheus shared best-in-class data for phase 2 for their ulcerative colitis and Crohn's disease with a successful use of that companion diagnostic in IBD. So on the heels of that news, they raised a $500 million in follow-on financing, and they're on to beginning a phase 3 study. Prometheus is a big position across all the RTW funds, and it's the largest position in the venture fund today at over 15%. It's followed by Rocket, Jisheng, and UK darling Immunocore. Next slide. Okay, so as you can see, the venture fund suffered its share of volatility during this really dramatic bear market over the last couple years, but it's begun to recover and inflect upward. And more about the sell-off and our outlook to come. If we can just go to the next. Yeah. All right. So new drug modalities. This is actually one of our favorite slides to talk about. If you have a look here, this is a really important visual because the timeline is telling you a lot. I mean, when you consider that small molecules represented innovation, look at how long that period lasted. It was for decades. And it wasn't until the late 1970s, when biotech was born, that you had a new emerging innovative way to treat disease. And so you had recombinant proteins take center stage for another 20 years. And that was until bispecific antibodies came along. And then, within a decade from there, came RNA interference. After RNA interference, it was a mere couple of years before we added AAV gene therapy and CAR Ts. And then in the last 3 years, we've added messenger RNA, protein degraders, and in vivo gene editing. So we're truly living in the golden age of innovation, and it's accelerating. Next slide. Okay, this is an ugly chart. 2022 was tied with 2008 for the second worst year for the Russell 2000 Biotech Index ever. And it was behind only 2002, 54% drop. That was when the genomics bubble burst. And you may recall that 2021 was also a down year in biotech. So back-to-back down years make for a really challenging environment. And virtually all of the generalist capital has run for cover. We've finally begun to see evidence of a recovery, and don't think that we'll retest the lows that we saw in summer of last year, in part because of real value creation in the form of novel drug approvals, such as Biogen Eisai's Alzheimer's breakthrough with lecanemab, and then also the GLP-1 class for obesity and diabetes. Next slide. Okay, what now? So with the number of small caps trading below cash at all-time highs, valuations are incredibly compelling in the public markets. And while we still have our work to do to underwrite winners, the asymmetry we're seeing is exceptional. We're in one of the best risk reward environments that we have ever invested in. 65% of companies below a $10 billion market cap are trading at less than 2 times cash, and a staggering 37% of those companies are trading below cash. Now, the market has already written those names off, so any more shock waves or any bankruptcies will not really have, that great of an impact that they might have had in the last 2 years. What's also an interesting stat from the bullish IPO vintages of 2020 and 2021, the average company that IPO'd during that time is down between 40 and 50%, with actually 70% of those vintages trading below cash. So, thankfully, though, we are off the lows and we don't believe we're going to retest those levels. The pharma index was actually up 5% last year, and small caps tend to trail, but we should see a recovery in small caps. Finally, M&A. Large pharma has an excess of $300 billion in their war chests, but have allocated a mere $50 billion to M&A in 2022. One of RTW's positions, Syncor, is a company developing a therapy for patients with hypertension and cardiorenal disease, was acquired by AZ in the first week of this year. So maybe this is a sign of more to come. That's all I have in terms of prepared remarks, but happy to answer any questions or anything top of mind. Thank you.
Great. No, thank you. That's a proper sort of tour de force of the sector, I think.